What if I told you the dividend debate has been done all wrong? I was shocked to find out that I had been focusing on the wrong metrics. I'm going to share what I've learned about dividends over the last decade of investing and save you years of investing mistakes in the next 10 minutes. Grab a drink, take a seat, let's talk about it. What's up, y'all? It's Brian. The first step is to ground the discussion. We want to make sure that we're focused on the right thing. And when we're investing, the number one goal is to get the most money possible with a reasonable amount of risk. Anything else is just the path to get there. So dividend is one possible path. Buying and selling shares is another possible path. And multiple paths can be taken at the same time. But if we get too attached to the path that we're taking, we lose sight of the end goal. That is where many people make the first mistake when they're trying to understand how useful are dividends for meeting my goals. Number one, the total return. How much money are we getting for our investments? This comes in two different forms. Either the company is growing their share price, or they are paying me a dividend, or some combination of the two. I can get a high total return by going to the casino and putting my life savings on red. I could double my money in an instant, but there's less than a 50% chance of that working out. So the risk is also a factor that we need to take into account. Dividends do affect the risk. That is something we're going to keep in mind going forward. I like to think about total return in terms of how much money is a company making, and then what are they doing with that money? Now that I'm focused on the total return and I'm not too focused on the path that I'm taking to get there, the next question is, what is that total return? And that is, how much cash is a company generating? So if I'm going to buy a company, and this is the way that you got to think about all stock investing, is if you were buying that company, how much cash are they actually making? When a company generates revenue, they're going to do something with that cash. They're either going to spend it on things that benefit me as a shareholder, or they're going to spend it on things that don't benefit me at all. So let's take Johnson & Johnson as an example. This is one of the biggest, most iconic dividend payers of all time. Together with its subsidiaries, they engage in research and development, manufacture, and sale of various products in the healthcare field. So Johnson & Johnson sells all these products, they make a revenue, they have cost of sales, for instance. Like, I don't really care about the money that they spend on upkeeping their buildings and paying their salaries for people that are just selling the products. These are actually expenses that I want to see them reduce. I want them to be more efficient. So the cost of sales, that's something that I don't care about. Now, if they're spending their money on growing, if they're buying new plants, new properties, new equipment, if they're spending money on research and development, these are things that can increase their future revenues and increase their future profits. So if they're spending money on that, that's good for me. If they're spending money on dividends, well, that's also good for me. That puts actual cash in my pocket. But the dividend is just one small part of that total return equation. Some companies don't pay a dividend at all, but that doesn't mean that they're not returning any money at all. They could be spending all of their money on growing their future earnings or paying off their debts, because the more money a company spends on paying its debts means in the future they're going to have lower interest payments, which means they get to keep more of their profit at the end of the day for spending more on growth and more on potentially dividends. So now that I know that dividends are just one small part of the equation, is there anything bad about dividends being in that equation? What are dividends actually doing for me, or are they hurting me? If you talk to people who love dividends, who swear by dividends, one of their biggest arguments is that they like having a reliable stream of income in retirement. Now, there are some kernels of truth to this, and then there are some misconceptions. Whenever a company pays a dividend, their share price drops by the amount of the dividend because they're losing money. The company's actually worth less the moment they agree to pay a certain dividend. So receiving a dividend from a company is the exact same thing as just selling a small portion of the shares. In fact, it's a little bit worse in one sense because the company decides how much you get in the form of a dividend. If the company is paying more dividends than you want to spend, well, now you're just being taxed on dividends that you don't need. It would be better in that case for you to just not sell any of the shares or sell fewer shares. And then that way you only sell what you need. So in one sense, the dividends are worse for you because it is a tax drag and it's less flexible. Now, on the other hand, a dividend is not affected by the current share price. Companies can be oversold or overbought in the market because humans are not perfectly rational. Human beings are emotional. And when we have a recession or if the market is crashing, people get scared and they sell companies that may not be rational to sell. Maybe a company isn't actually losing revenue because of the crisis. Take COVID, for example. Many companies actually benefited during COVID because people were indoors more. So companies like Home Depot, more people wanted to upgrade their homes because people spent more time in their homes. So there are reasons why people can sell out of a company for fear and not out of logic. So if a company gets oversold based on fear, and then you have to sell shares to fund your lifestyle, well, now you're being forced to sell when it's very low. Whereas if you're receiving dividends from that company, if the company's profits aren't really affected, you don't care if the company goes down in value, you're still receiving the dividend that is being paid from real profit. So in that case, the dividend part of the equation is actually nice whenever there's a market crash. Dividends are good. Now, if there is no market crash and you're just trying to grow your portfolio and you're being paid dividends and you're reinvesting those dividends, well, now you're being taxed every single time they pay the dividend, and it's an unnecessary tax. Now, one way you can deal with that tax is by keeping your money in a tax-advantaged account, like a 401k or an IRA, in which case you would be removing that downside. But in terms of safe and reliable income, sometimes it's very good. During a market crash, very nice. If the market's not crashing, then more of a drag and there's less flexibility. For people who avoid dividend-paying companies, the number one reason that I see cited is that a company who's paying dividends, they are admitting that they cannot spend that money on growth and they do not have a good way to grow their company. Now, once again, there are some kernels of truth to this one, but there's also a lot of confusion. So a company that pays a dividend, yes, for that portion of cash, they don't have anything better to do with it. So if the company thought that, hey, if I take this cash and reinvest it in the company and I'm going to see a 20% return on that reinvested cash, oh, you would want that company to reinvest the cash. But in life, there's diminishing returns with everything. There's only so much money you can cram into R&D and into marketing and into expanding your plants and buying more properties until eventually you're just not going to get the same return. So for the portion of cash that a company is not confident in the return, they're much better off just paying that out to shareholders with a dividend. Because cash that I receive in the form of a dividend, I can invest it anywhere I want. If I invest it in the stock market, there's an average annual return of about 10% in the S&P 500. If the company doesn't think that they can beat 10% reliably, well, maybe I would want that paid out in the form of a dividend. So it is true that a company that pays a dividend has less growth on the horizon, but this is 100% overblown. For instance, let's look at one of the number one growth companies, Google. In the last 10 years, Google has increased their share price by 500%. That is a little over 6 times in the last 10 years. This is definitely a growth company, and they have not paid a dividend until very recently. So currently they have a dividend of 0.46%. That's very small. And when I go to their financials and I go to their cash flow statement, I can scroll to the bottom and see in their financing cash flow, common dividends paid. So in 2024, they paid $7.3 billion in dividends. But when I scroll back in time, I can see a 0 in that row going back the last 10 years. They have not paid a dividend. They have been growth. Typically, people who hate on dividends would say, see, Google has had plenty of growth opportunities, so they're not spending any money on dividends whatsoever. But if you look just one row up, we see repurchase of common stock. This behaves almost identically to a dividend, except you do not have the tax drag associated with a dividend. So imagine a company pays you a small dividend, their stock price goes down because they lost cash, and then if you then reinvest that cash by buying more shares, basically increase your share of the company's ownership. Now, if you think about a share buyback, the way a share buyback works is the company takes the cash and they use it to buy back shares from the pool of stock that's outstanding. So now every share that I own is now worth more. It's a bigger slice of the pie. So think of it this way. Let's say I pay $1 and I am owed 1 slice of pizza. So I go to the pizza party, there's 1 large piece of pizza and I get 1 slice. So if I get there and there's 100 slices cut into it, I'm going to be bummed because I'm like, oh, that's a tiny sliver of pizza. But If I go there and there's 20 slices, well, now I'm still only getting one slice, but now the slices are bigger. It's because the number of shares have been reduced. In other words, the company buys back slices of pizza or they make all the slices bigger. It's kind of a weird analogy, but that's how it works. So it's very similar. So if I look at Google and I go to the share buybacks, in 2024, $62 billion spent on share buybacks. In 2023, $61 billion, $59 billion, $18 billion in 2019. This company has been spending money on share buybacks for the last 10 years, tons and tons of money. But do people still consider them a growth company? Absolutely. But they're still spending cash on things that are not growing their revenue. Share buybacks increase the share price, but they're not money that goes towards growth at all. If instead Google was paying a dividend this whole time, yes, their share price would have been a little bit lower because there would be more shares. However, their revenue and their profit would be the exact same as it is today. They would have just paid out more dividends instead of growing their share price. Now, there are pros and cons to this. Yes, you do not have a tax drag if a company is doing share buybacks. And yes, their share price does increase. However, there's also the risk side of the equation. If the money is staying in the company and then the company one day has a downturn, then all of the cash that they put into share buybacks, it kind of evaporates, especially if the company goes out of business or something. Now, I know with Google, it's not very likely that the company is going to go out of business, but if their company is severely damaged, the share buybacks don't really help you as much anymore. Whereas if they were paying out dividends that whole time, well, now you've been able to potentially diversify that money into other investments, and you would have still seen a return from that money over time. So receiving a dividend can reduce the overall risk of the investment, especially if you are diversifying your investments from the dividend. Now, if you are just paying that dividend back into the company and buying more and more shares, then it does not affect the risk profile of your investment at all. It would be very similar to share buybacks, but with taxes. At the end of the day, focusing too much on dividends is like saying, I am not going to practice biking at all for my triathlon. The most important thing is running and swimming because all the best triathlon athletes are really good at those two tasks. So I'm not going to focus on it at all. See, it doesn't make sense because biking is still an important component of my overall success in the triathlon. And likewise, saying that I'm only going to focus on biking doesn't make sense either, because if I'm a good runner and I'm a good swimmer, that's also going to benefit me. Similarly with dividends, it's just one piece of the total return that a company is giving me. The most important thing is the size of that total return. If dividends are present, fine. If dividends are not present, who cares? As long as the total return is as big as possible and the risk is as low as possible. Now, there are going to be a lot of companies that have dividends that are also having great returns over time. And that's awesome. And there's growth companies that don't have any dividends that are also going to have great returns over time. The important thing is, if I'm going to manage my dividends at all, I'm just going to think about what are the tax implications of those dividends. If there is a company that I really want to invest in and they happen to pay a big dividend, if I have the option, I'll invest in my tax advantage account. If I don't have the option, I'll invest anyway, because at the end of the day, the taxes on dividends are just a small portion of the tax bill. A dividend is typically around 2%, and dividends are taxed at long-term capital gains. So over a 20-year period, if I am receiving a 2% dividend, then I'm only going to be losing about 15% of that 2%. And yes, it is a drag over time, but if the company is a great company for a very cheap price, then I'm willing to put up with a small tax drag on my portfolio. But picking the wrong account can cost you hundreds of thousands of dollars. So check out this video to avoid that mistake. Cheers. That's a good one. Lily, Momo?